Good morning, everybody, and welcome to today's webinar, How to Sell and How to Buy a McDonald's Restaurant or Restaurants. My name is Mark Kashgegian, and I'm a partner here at Gray, Gray & Gray. We've been serving McDonald's owner-operators for well over 50 years, and I've been working with owner-operators myself for 32 years. I'm very well versed in your business, and this is a hot topic today. It seems to be something that we're seeing a lot of. I can't, in the 32 years that I've been working with McDonald's franchisees, I don't remember a time when owner-operators are either thinking about selling restaurants or actually engaged in selling restaurants. It must be a sign of the times. I know that the business has had its challenge over the last few years. Many new things on the horizon with breakfast all day, and we hear things about create your taste, and it's got a lot of people thinking, and that's why we felt as though this would be an appropriate time to do this type of a webinar. We're going to look at both sides of this. There's a picture of me. If you don't know who I am or haven't seen me around, I am around, spend a lot of time at various ROAs and do presentations here and there. But what we're really going to cover today is on the seller side, some of the things, important considerations you need to make when thinking about selling your restaurants, or actually in the actual act of selling your restaurants, and obviously on the buyer's side as well. What are some of the things that you need to consider? What are some of those important topics that you need to have in mind as you go to buy restaurants? We're also going to talk about the important tax considerations that you will need to keep in mind, and obviously what some of those post-transaction considerations will be. So if anybody has any questions during this webinar, there is a raise your hand button. Please raise your hand, type in your question, and I will get to it either at that moment, or if I find it more appropriate, we'll handle it at the end of the webinar. So let's begin. As I said, we have, we have almost close to 15% of our owner-operators are either engaged in selling restaurants or thinking about selling restaurants. So this is a sign of the times. But one of the things that you want to consider is a lot of times owner-operators today will come up to me and say, Mark, I want to sell my restaurants in the next year. I would like to sell them 3 years from now, 5 years from now, 10 years from now. So the kind of, where do you start when you engage in this selling process? Well, first off, there are many considerations that we need to consider. Reinvestment's a big one. I mean, McDonald's is a business that is constantly reinvesting. We know we're trying to rebrand the system. Many stores have already been rebranded, some yet to come on the horizon. Also, we have many initiatives. Breakfast all day, create your taste, obviously the McCafe and all that stuff that's happened over the years. So there's constant reinvestment. So we got to consider, what is our reinvestment? How much reinvestment is going to be required over the next X amount of years, and when are we going to be required to do it? Always remember, the closer you are to required reinvestment, whether it's an MRP, a rebuild, or a reload, the less equity or value you will have in that business. Okay? Very important consideration. So if you're a McDonald's owner-operator that is out there thinking about selling either today, within the next year, or 5 years from now, you have to really look at your stores. You have to look at the age of your store. You have to look at what those reinvestment initiatives or those reinvestment plans are going to be. Don't forget, McDonald's always has a vision plan for every restaurant in the system. They should be sharing those vision plans with you. But if they haven't shared those vision plans with you, you should be asking the corporation what the vision plan is. Because you need to understand when an MRP is going to be required, when a rebuild is going to be required. Because as you get closer to those dates, as I said, it's going to affect the value of your restaurant, because the buyer is going to have to take on that big chunk of reinvestment. Lease renewal dates, that's an important one as well. Always understand and know when your lease renewal dates are on your restaurants. So these are all considerations that you need to think about when trying to figure out when the most appropriate time is to sell your restaurants. In my opinion, if an owner-operator asks me that question, my answer is going to be the most appropriate time is when you're going to get the most value out of your restaurants. So that's why it's really important. We actually have an exercise we go through where we look at each one of the stores and we take into consideration almost every factor you could think imaginable. We look at the date the store was actually built. We look at the date it was most recently MRP'd or rebuilt or reload. We look at contribution margin. We look at trailing 5-year transaction count in sales history. Are there increases or decreases? We look at obviously all of the financial metrics of the restaurants. We look at norm reports. We look at the quintiles, and we kind of take all this into consideration when we look to value these restaurants. But what's most important about that exercise is that we look at value today, but we also look at value 3 years, 5 years, 7 years, 10 years from now, so that we can give that owner-operator the ability to figure out when does it make the most sense. We just recently had an owner-operator come to us and said, I want to retire in 7 years. Can you tell me what my restaurants would be worth in 7 years based on certain assumptions? And will I have enough money if I sell these restaurants and I pay off what I'll have in debt at that point in time, and I take into consideration what my tax burden will be on the sale? Will I have enough money that will last me through life expectancy? We went through the exercise, and it turns out that 7 years wasn't the right number. It was more like 9 years. But that's good information to know as you begin this planning process of whether or not you want to sell today, tomorrow, or years out. State of the business. Where are we today? So in many markets across the United States, we have decreasing sales. We have decreasing cash flows, weakening cash flows. The business, there's uncertainty in the business model. Many owner-operators are very reluctant to do anything today because of the uncertainty of the business model. Where are we going? We talked about some of these new initiatives, breakfast all day, create your taste. You know, again, there's uncertainty. When there's uncertainty, owner-operators, businessmen, entrepreneurs are very reluctant to do anything. And that's very understandable. But we take these things into consideration when we're talking to owner-operators about selling their restaurants. And these are some of the things that are, by the way, that are driving the onset of sales that we're seeing today. Retirement planning approach, again, this is what I talked about a few minutes ago. How much money do you really need during retirement? Again, in that exercise, not only we talk about what the value of your restaurants are and what cash you'll get out of it after tax and after debt, but really also the assumptions of how much money am I going to need to live on post-tax in my retirement. You know, I'm obviously going to get Social Security, but how much additional money do I need to live the lifestyle that I want to live? And will the value of my stores support my retirement projection? And again, like I said, you may or may not be able to retire or sell within that number of years you might have in your head, and that's why we think today it's very important to go through that exercise as to what are my stores worth, when will they be worth what I would like to take out of, to be able to take equity from these restaurants to be able to retire and live comfortably. So now that you've made this decision to sell, whether it's a year from now or whenever it is, what do we need to consider and how do we start? So the first thing we would do is you got to value your restaurants. And again, you have to take into consideration future reinvestment, NRBES. You got to consider those lease renewal dates, the age of the restaurants. A buyer is going to be looking at all these things. That's why it's important for us to consider these when we value your restaurants. Again, those vision plans. McDonald's does have vision plan meetings once or twice a year, region by region. And they look at stores independent of who owns them. They're just looking at the infrastructure of the store. They're not looking at you as an owner of that restaurant, but just really what does that restaurant need, and when do they feel as though they need to make changes to the infrastructure. Need to Again, the restaurant sales and transaction count trends, very important. Norms, contribution margin, quintile reports. People, your team has value, believe it or not, and the buyer is going to look at your people. And then, that competitive analysis, right? What does the place look like in your restaurants? Is all the competition in place? Is there potential competition to come in? In a lot of regions, we're seeing Sonic coming in. We're seeing other different QSR brands coming into Chick-fil-A, coming into regions. That, believe it or not, does affect that competitive marketplace analysis that we look at. Once we figure out what the valuation is, and we use several methods when we value a restaurant. We look at that multiple of cash flow that you're probably all very familiar with, and a lot of your financial viability ratios consider that cash flow multiple. But we also look at discounted cash flow. That's looking at your restaurant over, of course, the next 20 years, takes into consideration the time value of money and all of the reinvestment that's going to take place. That's another very effective way of valuing a restaurant. We'll look at both methods when we do that. We'll look at those retirement projections. If, in fact, you've engaged a trusted advisor, a CPA, to put those types of projections together. We'll talk about negotiations. When we value and set that selling price, it's always good to have in mind a ceiling and a floor. And you really want to make sure the ceiling is a realistic price. A lot of times we have owner-operators that are shooting for the stars, and they're looking to cash out and have that big payday. But sometimes that value that they put out there is very unrealistic. And that a future buyer, even if they put down 25% on the sale when they purchase those restaurants and finance the rest, they still wouldn't be able to cash flow. So, we look at that kind of stuff. We'll set that ceiling and we'll say, is it realistic? Can a buyer afford to buy these restaurants at that price? And that's that where I have down here, run debt analysis, because the buyer will. We're going to do that. And your CPA and trusted advisor should do that for you. Run that debt analysis to find out if, in fact, that ceiling is a realistic number, and can the buyer afford to buy it at that price? Now, I refer to a seller's package here. McDonald's has a seller's package, and I just brought it up on the screen. All of these things, by the way, the seller's package and the buyer's package, can be accessed on Access MCD. But this is a copy of what a seller's package looks like. We have to give some basic information on the restaurant, reference to your accountant or your solicitor. Let me see if I can click through this. Here's some of the restaurant information, franchise start date, purchase date, termination date, own site, lease site, type of restaurant, playland, drive-through, and all that kind of stuff. The buyer is going to want to know all this information: number of seats, parking lot, trading hours, etc. And it continues. The people. What's the people look like? What does your team look like? Management positions, names, start dates. All of this is part of the seller's package. Any benefits, turnover. So you can see you're really telling that buyer an awful lot about your restaurants. Sales and profitability. They're going to ask for P&Ls. They're going to ask for statements of performance. You're going to have to provide all that information, pays, sales comps, all that kind of stuff. So they're going to know everything about your restaurant that you know. Obviously, down below, list any proposed or potential McDonald's to open at this restaurant's trading area. Also, other type of competition either coming or leaving the area. Comments on significant issues that will affect future sales. Obviously, that's the traffic generators, major employers, major retail chains, schools, etc., that type of stuff. Obviously, traffic flow changes, and then reinvestment. They want to know everything about your reinvestment. any sorts of contracts that you may have, whether or not you own the building, and is the buyer going to assume that note? So look at this is an awful lot of information here. Equipment, stock, and then obviously you have to talk about the sales price. Why are you selling? And then look at all of this stuff, valuation formulas, how you arrived. So there's a lot of stuff here. So very important that you, when you engage in this process, that you really spend some quality time with your CPA and trusted advisor going through that seller's package. But most importantly, as you value the restaurant, knowing that you're valuing it and that you have a very realistic price. As I said before, we have an owner-operator recently that has I think a 2 or 3 store package, and that we talked about a ceiling. We came to what we thought a realistic ceiling would be in the marketplace, and the owner-operator added a couple $1 million to it. When they went to the marketplace, they did not get any bites. In fact, I think they probably, I don't want to use the word, but they probably made a lot of other owner-operators a little bit upset at the asking price on those restaurants because it wasn't realistic. So it's very important that you do set a ceiling, and we need to have a ceiling. We need to know the floor as well, but make sure those numbers are realistic. Find the right buyers. So that whole process, contact the QSCVP in your region. I would say that would be step number 1, because as you know, some owner-operators are financially viable and expandable for growth. Others are not, and you don't necessarily know who those people are. So it's very, very important that you have an understanding of what your pool of buyers could be. They must be expandable. The QSCVP will most likely all the time will assist in promoting your restaurants. There's also a registered applicant pool out there. There are registered applicants that are looking to grow. And then it's important to understand the geography. There are owner-operators, believe it or not, that want to expand in new regions. And the QSCVPs usually know that, because they talk to one another. So they may have an owner-operator that may want to expand to a different region. So definitely utilize that relationship with the QSCVP, but also utilize your CPA. I think this is very important, especially if you have a CPA that has several McDonald's owner-operators. They may know some of their owner-operators that are looking to grow in the region that you may be selling restaurants, or they may have owner-operators in other regions that are looking in other regions. So very important. CPAs do network, especially the ones that have significant McDonald's niche practices. They do network with some of their other owner-operators. In our case, we have owner-operators in several regions, so if an owner-operator is looking to sell, we're always who that buyer could be. And then we also are part of a network where 1,200 McDonald's owner-operators are represented, so it also gives us an opportunity to throw it out and promote it that way as well. So between your QSCVP and your CPA, that's probably the best opportunity to be able to find the right buyers for your restaurants. Negotiating the deal. So what you're going to have to do is provide that buyer with the seller's package and your financial statements, but work very closely with your financial advisors. Very, very important to stay abreast of what's going on. NEP loans, a lot of times you will have a situation where you actually own the building in your restaurants. Know that that becomes part of the negotiating as well, that buyers sometimes most likely will assume the ownership of that building and assume the note as well. And in some cases they don't. And in some cases they split it. We've seen things all over the board, but that becomes a part of the negotiation if you have an NEP loan, and knowing how you're gonna handle that part of the transaction. Tax considerations, timing of the sale, January 1st versus December 31st. I'll be honest with you, if I had an owner-operator that came to me today and said, look, I want to sell my restaurants and I want to do it in the next 3 or 4 months, I want to be able to close the transaction. At this late in the game in August, I would maybe even suggest, do we want to postpone this to January 1st? The reason why I'm going to tell you that is that if you're thinking of restaurants this year, postponing that sale to this January 1st of next year means that you will not have to pay the taxes on the gain of the sale of those restaurants until April of the following year. So that large sum of money that you will get, you can actually invest, and believe it or not, you could probably make some significant money on that, because you will not have to, if you sold on January 1st, you would not have to pay taxes until 15 and a half months later. So it would be April of the following year. So very, very important that when you start to think about selling your restaurants, whenever that is, think about the time of year it is and think about, does it make sense to do it now, or should I try to postpone it to January 1st? Installment sales. A lot of times owners will take back paper when they sell a restaurant, especially in a next generation situation. You can also engage in an installment sale where the sale takes place over a certain period of time versus all at once. So that's an important consideration to talk to your CPA or your tax advisor about. Section 1031 tax-free exchange. That's out there, and that's an important consideration as well. What that does is, if you're buying and selling restaurants, so if you're selling restaurants but buying other restaurants, Section 1031 allows you to postpone the tax on the gain on the sale of the restaurants. So that's an important consideration to consider. I mean, we could have a whole webinar on Section 1031 tax-free exchange, but know that that tax consideration is out there. Please talk to your advisors about that as well. What will you do with the money? So if in fact you do sell your restaurants, you want to be able to reap the benefits of that legacy that you've built. So you want to ensure that the restaurant sale and other assets are enough to support your chosen lifestyle during retirement and through life expectancy. And that's why it's important to have that financial plan, that retirement plan. I think that if you're selling restaurants or you're even thinking about it, you really need to talk to your CPA or your advisor about maybe putting together some sort of a retirement projection so that you can know and feel comfortable that based on the sale of the restaurants at this price, given my tax hit, given paying off my debt, will that sum of money plus all the other assets I own, net of liabilities, last me through life expectancy? So that's the seller side. Now you're a buyer, right? So you're growing through acquisition. And that's, I hope you're, if you're in the system and you're engaged and you're not ready for retirement or ready to sell, you're probably looking to grow and expand. But I tell my clients all the time, it's expanding is, can be an emotional decision, and it can also be a business decision. We're going to talk about the difference between emotional decisions. But some of the considerations before you buy: are you a next gen? Are you a registered app, or are you an existing owner operator? Each one of you may have different objectives when buying a restaurant. You need to have an understanding of what the rewrite policies are for SBOs, which are sales between owner operators. You need to have a copy of the bylaws, which again on Access MCD. You need to understand those methods of valuing restaurants, because the seller is going to value the restaurant, but you need to understand methods because you're going to give your own value to the restaurant. You need to have an understanding of the ownership of the building. Who owns the building? Does the owner operator selling own the building? Does McDonald's own the building? What's the real estate tenure of the property? Does McDonald's lease the site? Do they own the site? That's going to come into play, and that plays a big part into whether or not you're going to see future rent escalations in those stores. Are there additional properties associated with that restaurant? A lot of times there may be additional parcels of land adjacent to the restaurant. So very, very important considerations when thinking about buying a restaurant. Again, though, is it a good purchase? It's not always about owning X amount of restaurants. Especially in this day and age, it's important when you're buying restaurants, You want to buy restaurants that make sense for your organization. You want these decisions to be business decisions and not emotional decisions. Very, very important here. Is it a good purchase? Okay, so again, you're going to get that seller's package. You're going to look at those cash flow projections. You're going to look at sales forecasts. These are the types of things you're going to do. You're going to actually have historical information from the seller, but you may want to put together your own cash flow projections for the restaurants. You may want to put your own sales projections and sales forecasts. Will this restaurant add gains to your organization? I hope it will, because if it doesn't, it shouldn't be something that you're buying. What is that required reinvestment? The buyer is going to give it to you in the seller's package, but if you're a buyer, I'm telling you, you should be calling the corporation. You should be asking about what is the vision plan of that restaurant that I'm buying. The seller may not disclose that, but it's important as a buyer for you to understand what is that required reinvestment. Is there an MRP looming on the horizon? Is there a rebuild? You need to know the age of the restaurant, because that's going to help you to understand what that required reinvestment is. What are the lease terms? When is the lease term up? It's very important. What does that team look like that they have in place? And you got to put your own team together as well. But big, very important, post-transaction, after I purchase these restaurants, what is the transaction effect on my financial viability? Is it going to make it better or worse? I hope it's only going to make it better. Can I afford to do this? Am I going to be able to put cash down on a sale? A lot of times today, we find 100% financing across the board, whether it's buying or whether it's doing major reinvestment. Owner-operators just don't have a lot of excess cash. So they find themselves financing things at 100%. Well, that affects the debt service that you're going to carry, right? The debt load that you're going to carry on a purchase. So, you really need to look, does it make sense if you have cash to put cash down on that deal and reduce that debt load? You need to talk to your banker when you start that process, to find out, the affordability of financing and how able you are to obtain financing. And then obviously looking at financial viability. And we run projections all the time, post-transaction, of what that financial viability is going to look like. You got to do due diligence. It's whether you're buying a restaurant, or in our case, if we're looking to acquire a CPA firm, we'll spend a week to 2 weeks in a CPA firm doing due diligence, looking over that client list, right? So many different factors we consider. You as well as a McDonald's owner-operator need to do your due diligence when buying a restaurant. Verify the financial information that's given to you by the seller. Maybe request that you see FFS financial information from FFS to make sure that the financial statements that you're looking at from the seller are actually what was reported to McDonald's Corporation. Look at the leases. You want to find out, are there any rent escalations in that lease? It's very important for you to have a copy of that, or at least to know if there are future rent escalations. Ask to review the seller's package. So you're going to look at those store P&Ls. You're going to look at those norms. You're going to look at the sales and transaction count history. You're going to look at NRBES and reinvestment. You're going to talk to the regions about future reinvestment, right? MRPs, reloads, rebuilds. You're going to talk about rent escalations. You really need to do your financial due diligence in this process. But you also have to do your physical due diligence, and sometimes this one gets left aside, right? What does that physical plant look like? It's not enough to just walk around the restaurant and say it looks okay. On the roof, look at those HVAC units. So many times I've seen owner-operators buy restaurants, they get in there and within a month they find out that the HVAC system needs a $10,000, $20,000 repair. So it's very important to do that physical plant inspection. The equipment, right? The grills, the fryers, all of it. Is it in good operating condition? You don't want any surprises when you get in a situation to buy a restaurant. Is the roof, when was the last time the roof was done? If it hasn't been MRP'd or rebuilt, what's going on there with the roof. So these are just a few of the areas that we've seen issues with before, but you really need to do that physical plant inspection and make sure you have an understanding. Operational due diligence. Again, the team. You need to have an understanding of the team. Who's there? What type of people are part of that team? Because when you buy that restaurant, most likely you're going to take that team on, and it's really important to understand that team because they are running that restaurant on a day-to-day basis, and now you're going to have to make some major changes. So doing due diligence from a buyer's perspective is very, very important, whether it's physical, financial, or operational. When you structure the deal, you're going to work with your CPA and financial advisor. You want to determine what that affordability is and what post-transaction effects are going to be on pre-debt cash flow and financial viability. You also, when buying a restaurant, want to tangibles, such as future growth in that market. A lot of times an owner-operator may want to get into a store, may overpay a bit because A, they see future potential in that market, or B, the owner-operator that's selling the restaurant isn't selling all of their restaurants, is just selling a piece, and we see a lot of that today, by the way. They're selling a piece of their operations, but maybe will give you right of first refusal for the remainder of those restaurants over a period of time. So these are the types of things that you got to consider. And again, I will say we are seeing a lot of that. Owner-operators aren't necessarily getting out fully, but want to sell a patch of their restaurants to begin to start that process because they may want to pay down debt on their own side to be able to do some reinvestment in their restaurants, but eventually will sell out. You want right of first refusal. You may even want to start negotiating how you're going to value those restaurants at that point in time. All very important. Also, when structuring the deal and determining whether or not the price is affordable, you got to consider the tax effect on. When you buy a restaurant, you will be able to capture some depreciation. Now, unfortunately, our government over the last couple of years hasn't been quick with telling us that some of those accelerated depreciation provisions like Section 179 and bonus depreciation are going to continue year after year. Right now it's August, middle of August almost, the 13th, and we don't know if Section 179 and bonus depreciation are going to continue in the accelerated fashion that we're used to. Right now it's limited, it's very small. But it's very important to have these discussions because if in fact we will reap the benefits of accelerated depreciation, it will help to lower your tax burden on taxable income in year 1, year 2, and year 3, which may help you to project whether or not you can purchase these restaurants and whether or not it will have a positive effect on your financial viability. So very important to consider tax effect on depreciation. Again, obtaining financing, you got to contact your lenders, and hopefully you all have a great relationship with your lenders. Very important. Consider that down payment, and obviously review your existing debt. Each one of you have what we call a debt schedule, and you can access that on FFS. But you want to know what your existing debt is and when you're going to retire debt. It's very important to understand when you're going to retire debt because that comes into play as you obtain new debt, right? So that'll at least give you an understanding of when you can maybe take on some of these new initiatives or new restaurants. That's what I have. We talked a little bit about the seller side and we talked a little bit about the buyer side. Most important when considering these types of things, you really need to work with your CPA and your tax advisor and your financial advisors to make sure you're structuring the deal properly on the seller side, and as a buyer that you can afford to do this and it makes sense for your organization and you're going to gain from it and have better cash flows from it. So, you know, I can't stress the importance of really doing that due diligence on both sides of the equation, whether you're a seller or a buyer. So we're going to probably be doing a lot of these types of presentations over the next several months. But I do also want to tell you one thing as we start to head into the fall, and we'll be doing a webinar on this in the future. I want you to start to think about ACA and Obamacare, and are you with a payroll company that is ACA compliant? This is very, very important because I got to tell you, you know, we haven't felt the full effects of this, but at the end of 2015 and going into 2016, Obamacare kicks into full gear, and it's very, very important that you make sure that your payroll companies are ACA compliant, and they are going to handle all the administrative needs with regard to these new regulations. It's very important. We're finding out that there are some payroll companies out there that aren't necessarily fully compliant and aren't going to provide you with what you need. It's very, very important to make sure that you talk to your payroll companies and you know that they are ACA compliant. We're actually going to be putting together a checklist, and if you want a checklist, please email me and we'll get you out one. But this will be a checklist for owner-operators so that they can know the types of questions they need to be asking their payroll companies to make sure that they're going to be compliant, because the penalties can be pretty severe, and it's very important that our owner-operators don't get into situations where they're not compliant and that their payroll companies aren't doing what they may have thought they would be doing. So very, very important. Also, we'll be out at the ROA season and hopefully visiting your region. Please stop by. We'll have all kinds of information for you. Again, stay tuned to our future webinars. I hope you got a lot out of it today. I'm kind of looking here for questions, and I don't see any at this point in time. Again, I thank you for your attendance. We had several owner-operators from all over the country today. So look forward to seeing you and hearing more from you. Have a great day.